Welcome. Today is Thursday, April 14th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners, editor of Alpha Insights, and this is your Daily Five. Well, today we're going to talk a little bit about inertial turbulence theory. We're going to jump right into it here on chart number one. So the whole point of this discussion is really to understand the concept of a turbulent eddy cascade. So what's an eddy cascade anyways? Well, a theory known as inertial turbulence theory was developed by this obscure Russian mathematician slash geophysicist by the name of Andrei Komogorov. And he came up with this idea back in the late 1940s. And what his theory basically does is it states that the flow of energy moves from larger scales to smaller scales, but not in reverse. And so the tipping point of the flow of this energy is known as an eddy. And the interaction among eddies at various scales passes energy from the macro scale to the micro scale. And this whole process is known as a turbulent energy cascade. And so what the diagram is basically showing you is that, if you can imagine water flowing down a staircase, water kind of hits a stair, it plateaus out, and then there's a tipping point where suddenly it reaches the edge and it collapses lower, right? So we see these kind of waves or cascades of energy flow. So what we want to do is kind of figure out how we can identify a tipping point and what this really means for the markets. So let's look at the next chart, and we're going to talk a little bit about the 10-year Treasury yield, because from our perspective, we're very near a tipping point in the potential for rates to move significantly higher. And what this chart's really detailing is about a 40-year history of the 10-year Treasury yield from its peak back around 15% in the early 1980s to its current level, which was as of this morning around 275, as of yesterday's close around 270. And we think this is the single most important chart in the world today, because what's happening right now is that when 10-year yields rise like they have, we see PE multiples compress, we see cap rates rise, we see bond prices decline. This affects asset pricing models and valuations of all financial assets. And we think that the 10-year Treasury yield appears poised to challenge its 40-year downtrend line, and also chart resistance at around 3.25, which was achieved back in December of 2018. What we've already seen is a compression of yields, the spread between the 10-year and the 2-year yield, as well as the 30-year and the 2-year yield. And a couple of weeks ago, we actually saw a slight inversion on that 10-2 yield spread, and we got to net flat on the 30 to yield spread. And so, those tend to be signals, right? They tend to kind of indicate that something's about to change. Over history, if we look back at the past 5 inversions of the 10-2 yield spread, they actually occurred they actually preceded a recession by an average of around 12 to 18 months, in a range of around 10 months to 33 months. And what we think is happening here is that we are approaching a massive change in 10-year Treasury yields. And where we're looking right now very closely is this 280 level. That would mark a penetration of trend resistance. And if we saw a sustained move above that 280 level, it would indicate a massive change. A move above 3.25 would actually project a measured move to approximately 6%. Now, we're not saying that that's going to happen anytime soon, but once it does occur, if in fact we break above that 3.25 level, it would then put into play, not immediately, but eventually, the idea that rates could rally back to the 6% level, which we really haven't seen since all around the year 2001 or so. And so that's about over 20 years ago. So anyways, let's see how this all kind of flows together with our thoughts on the market in the next chart. Chart number 2 really indicates our view. I would call this our preferred view of where the S&P 500 stands right now. On the left-hand side of the chart, we're looking at about a 2-year history of the S&P 500, going back to February of 2020 through yesterday's close. And this is a weekly chart, and we've put on top of this a 55-week moving average to kind of give us a sense of the trend. And what we see is that, the trend has been penetrated already, and we've rallied back from that. So effectively the trend held, but we are now actually experiencing some weakness from the peak of that recovery, right? And so we've overlaid some Elliott wave annotation here, which indicates that the January 4th high marked the high of cycle wave 5, which is the move that we've seen from about 2009 to present. And with that, we now believe that we are experiencing the very, very early stages of a cycle degree correction, which could bring the S&P back substantially from where we are today. We have an initial target of 3,800 to the downside, and that'll be confirmed once the S&P breaches the 4,300 level sustainably. So we need to break 4,300 and hold below it before this target becomes valid. But we think we're on our way there. If we look at the right-hand side of the chart, we see some more detailed or granular sort of dynamics of what's been happening over the course of really the last 6 months or so, going back to September of 2021. And so if we really think about the decline that we saw off the January high, we count that as 5 waves down. And 5 waves down is the first move in a motive wave, which would be basically a larger degree version of what we saw into that February 24th low. Another 5 waves and a larger degree of trend. And so the rally that we saw back up to the March highs at around 4630 or so on the S&P 500 occurred in 3 discernible waves. And those waves mark a corrective action. That's wave 2 of this first volley down. And we think we've experienced a series of 1s and 2s to the downside that put us on the precipice of a third wave decline. And that's where this whole notion of this inertial turbulence theory comes into play, or the whole concept of a turbulent eddy cascade, because what we're seeing is energy flowing from the macro scale from a large degree into a smaller degree, smaller scales. And these scales will come down in waves at a very small degree of scale, and that will expand to, and that will form the larger degree scale. So that's the whole point of trying to tie this all together. Now, what we wanted to do is really give you some current evidence of what's happening at the micro scale. And so in the next chart, we're going to take a look at some of the names that are critical to the S&P 500's performance going forward. And the first of those is Microsoft. Microsoft is the second largest weight in the S&P 500. It's about 5.7%. It's got an enterprise value of over $2 trillion. And based on forward 12-month earnings estimates, the PE multiple's over 30 times. If we look at trailing revenues, it trades at a price to sales ratio of over 12 times. We've already noticed that relative strength versus the S&P 500 is now negative and trending lower. And the stock has breached its uptrend in late December and has since developed the characteristics that are classic or of a classic pattern top formation of the head and shoulders variety. Now, we believe that a sustained bearish inflection below $280 would confirm this head and shoulders top, and it would project a measured move to approximately $210 on the downside. So that's number one in terms of those kind of micro scales that could be affected from this macro scale that we're looking at. The next chart takes a look at the third largest weight in the S&P 500, Alphabet, or formerly known as Google. Now, GOOG is about 4% of the S&P 500. Its enterprise value is over $1.5 trillion. Based on forward 12-month earnings, it has a PE of 22 times. And based on trailing 12-month revenues, its price to sale is 6.6 times. Relative strength is now negative and rolling over. The stock breached its uptrend in mid-January, and it again has since developed these same characteristics of a pattern top formation of the head and shoulders variety. Now, a sustained bearish inflection below 2,500 in our view would confirm this pattern and would project a measured move lower to approximately 2,100. The next chart takes a look at the fourth largest weight in the S&P 500. That's Amazon.com. Amazon is about 3.5% of the S&P 500 with a $1.5 trillion enterprise value. Based on forward 12-month earnings estimates, the multiple it trades at is 62 times earnings. Based on revenues, though, the price to sales is just 3.3 times, in line with the market, but historically high for the market. Relative strength versus the S&P 500 is again negative, but it is somewhat improving. We've seen an upturn from the lows, and the momentum of that relative strength has actually turned positive. However, the stock did breach its uptrend in November and has since really developed again these characteristics that are consistent with a classic pattern top formation. In this case, there's a lot of ways to kind of draw the lines, a double top, some sort of a complex head and shoulders. But the point is, if we do see a bearish inflection below 2950 that's sustained, that would confirm this top formation. It would project a measured move to approximately 2150 on Amazon. The next chart is kind of our final series of chart here. We're looking at the chart of Nvidia, which is the seventh largest weight in the S&P 500. It's about 1.5% of the index. The enterprise value is a little over $500 billion. Based on forward earnings estimates, the PE is 38 times. Based on trailing 12-month revenues, the price to sales is 20 times. This is an outrageous price to sales. Relative strength versus the S&P 500 is now negative and trending lower. The stock is testing its uptrend for the second time this year. It has yet to break that uptrend, but it also has developed these characteristics of a classic pattern top formation. In this case, something that's more like an inverted cup and handle. But the message is really the same here. A sustained bearish inflection below 205. We're about 222 now, would project a measured move lower to approximately $60. So, we're looking at some pretty, scary charts and some of these heavyweight mega cap names that really dominate the S&P 500 and have a lot of influence over the directional bias of the index. Now, if you don't think that these charts can break, I just want to bring your attention to the final chart. And, this again is for the non-believers, those who think that these great companies that seemingly dominate the US economy and the market cap of the S&P 500, if you doubt that they can lose half their value in a matter of weeks, I present to you the chart of the company formerly known as Facebook. And this was once the fifth largest company in the S&P 500, but after breaching its uptrend in January, it swiftly plunged to its March lows, around 50% below its all-time high in a matter of weeks. So the message here is caveat emptor. With that, I'd like to thank you for spending your time with us today. And you can always reach out to me on my website or follow me on Twitter if you'd like to get more information. With that, thanks again for watching and good luck trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.